What is the earnings capitalization method of valuing a business venture? Well, to begin with, this is one of the income-based methods of business valuation, and it begins with trying to identify what are the normalized earnings of the company. Normalized earnings simply means the weighted average of earnings. So you look at present earnings and backwards and try to take a weighted average with the most recent being weighted more heavily than older or income streams from further back. And you'll adjust those income streams for any outstanding gains that are atypical, and you also oftentimes adjust it for any major executive compensation packages and things like that. Now, what you do is once you arrive at a normalized earnings or weighted average earnings that you would project, say for a given year, you divide that by a capitalization factor. Now, a capitalization factor is really just another word for saying a discount rate. So just like with a present value calculation, you're bringing what you believe to be the future earnings back to a present value using a discount factor, where here you're taking the single individualized earnings for the year and dividing it by, again, this capitalization rate, which is generally a percentage. Okay, so it will extrapolate based upon whatever that percentage is. So key here is the discount rate. Now, in startup ventures that are growing very quickly, you're going to need to account for growth. So oftentimes you use the Gordon growth model, and you just take whatever you determine to be your discount rate, you subtract from it the growth rate. And the reason you do that is because, again, you're growing, so the way to adjust for that discount rate is to subtract, again, the growth rate from it, and that'll give you the adequate discount rate. So in doing so, there are a number of ways you can get the discount rate. Most of the time, you generally look for a rate of return that you would expect from a market-based investment of this level of risk. Now, that's not always easy to identify. With a mature public company, you can do something called the build-up method, which uses individual market risk rates, and then you build up or add to it to determine the capitalization rate. But that doesn't work well for startup ventures because, once again, you don't have the mature market out there trading in these shares. So again, you come up with a risk rate based upon the nature of the venture, and you use that again as a discount rate or the capitalization rate if you subtract the growth rate from it. And that's how you do the earnings capitalization method of business valuation.